All right, welcome back to Journey to XRP. Strap in, because what you're about to hear is exactly why a lot of people are completely misreading this market right now, and why that's dangerous if you actually care about positioning instead of chasing headlines. Yesterday wasn't just another rate cut, it was a signal. And if you missed what the Fed quietly admitted, you're already behind. Let's get one thing straight from the start. The quarter-point cut itself was boring, predictable. Anyone acting shocked by 25 basis points hasn't been paying attention for the last year. That wasn't the story. The story was what came with it. A $40 billion liquidity injection when only half of that was required for basic system maintenance. That's not an accident. That's not a typo. That's excess liquidity being pushed into the system while everyone pretends it's business as usual. Call it whatever you want, the balance sheet operations, technical adjustments, or maintenance funding, the label doesn't matter. Functionally, this is the early stage of easing. Stealth QE, slow QE, drip feed QE, pick your flavor. The result is the same. Liquidity is turning back on. And here's where most people screw this up. They expect instant fireworks. They hear QE and think prices should immediately explode. That's not how this works. Liquidity doesn't hit risk assets like crypto overnight. It leaks in. It finds its way through treasury markets, T-bills, repos, and credit channels first. Only later does it spill into assets that thrive on excess capital. And crypto sits right at the extreme end of that spectrum. What's important right now is intent. The Fed is no longer fighting inflation at all costs. They're managing stability. That's a massive regime shift. When central banks move from restrictive to neutral and from neutral toward easing, risk assets stop being punished for existing. They don't need perfect conditions anymore. They just need time. Now add something else most people ignore. Crypto has been strong despite restrictive policy. ETFs launched, institutional flows showed up, regulatory posture softened, adoption continued. XRP didn't wait for QE to exist, right? It held its ground while liquidity was tight. That matters because assets that survive tight conditions don't need much oxygen to move once air comes back. But here's the uncomfortable truth people don't like hearing. This isn't going to be fast. Powell is not slamming the gas pedal. This is not 2020. There is no emergency yet, and central banks always wait until something cracks before they act aggressively. That's how they've always behaved. They preserve ammunition until they're forced to use it, which brings us to the real accelerant nobody can predict with precision: replacement risk at the Fed or systemic stress elsewhere. If leadership changes and a more aggressive easing stance takes over, everything speeds up. If unemployment spikes, credit markets seize, or a major financial institution stumbles, easing goes from gradual to necessary. That's when things move violently. Until then, what we're in right now is positioning time, boring time, the phase where impatient people get shaken out and disciplined capital sets up quietly. This is where narratives form before price confirms them. And that's exactly where XRP thrives. Not on hype, but on infrastructure, liquidity rails, and regulatory relevance. Now layer on what's happening outside monetary policy. Market structure legislation is crawling, yes. Welcome to politics. But the direction is clear. Pro-crypto regulators are stacked across agencies that used to block this industry entirely. Compared to the previous administration's hostility, delays now are noise, not threats. The difference is intent again. They're building frameworks, not weapons. Banks see it too. When Bank of America starts rolling out Bitcoin-backed products, that's not experimentation. That's fear of irrelevance. Legacy finance doesn't move unless it has to, and it's moving now. That domino effect doesn't stop at Bitcoin. It never has. Once access pipelines exist, they expand. XRP sits right in the middle of where payments, settlement, and tokenized value converge. So if you're wondering why price chops while fundamentals strengthen, here's your answer. Liquidity hasn't fully arrived yet, but it's turning. And markets move before headlines confirm it, not after. That's the trap most retail falls into every cycle. Now let's push this one level deeper, because this is where a lot of XRP holders completely misinterpret what institutional adoption actually looks like. They're waiting for a headline that says, "Banks buy XRP, price explodes." That's not how this phase works, and if you anchor your expectations to that, you'll get frustrated or shaken out early. Institutions don't buy the way retail buys. They don't chase green candles, they don't ape into spot markets, and they don't announce their intentions ahead of time. They build rails first, quietly, methodically, and that's exactly what's happening right now. When you hear Jamie Dimon openly saying blockchain, stablecoins, and smart contracts are real and will be used to improve settlement and customer service, that's not bullish talk. That's operational confirmation. JP Morgan already moves trillions per day using blockchain infrastructure. That's not testing, that's production. Nobody experiments with $1 trillion ever. Once you understand that, the whole market looks different. Here's the key point most people miss. Banks don't care which token moons. They care about efficiency, compliance, interoperability, and control. They will absolutely build their own coins, their own ledgers, and their own permission systems. But that creates a problem, fragmentation. Bank of America is not going to settle on a JP Morgan coin. European banks won't want a US-only system. Asia won't surrender monetary rails to one institution. You need a bridge, a neutral layer. That's where XRP fits. Not as the system, but as a connective layer between systems that refuse to trust each other. That role doesn't show up overnight on a price chart, but once it's embedded, it's incredibly hard to replace. That's why XRP keeps surviving cycles while thousands of other tokens disappear. Now add tokenization into the mix. Larry Fink calling tokenization the pre-boom internet phase is not hype, it's a warning. Everything that can be represented digitally will be. Bonds, equities, treasuries, real estate, commodities, that's not optional, it's efficiency math. And tokenized assets need settlement rails that are fast, cheap, liquid, and globally compatible. People love saying XRP won't be used for everything. Correct, it doesn't need to be. Even a small percentage of global settlement volume moving through XRP changes the supply-demand equation dramatically. This isn't about fantasy numbers, and it's about scale. 10% of a massive system still dwarfs most crypto markets. But here's where you need to stay grounded. None of this works without liquidity conditions aligning. Right now, liquidity is tight. Rates are still high. Capital is cautious. That's why price hasn't reflected infrastructure progress yet. This is the part where weak hands confuse delay with failure. Look ahead to 2026. Rates lower. QE returns in some form. Risk appetite increases. Capital looks for yield and efficiency again. That's when infrastructure that's already built starts pulling value through it, not before. Markets don't reward preparation immediately. They reward readiness when conditions flip. And this is where patience becomes an unfair advantage. Most people want confirmation first and position later. By the time confirmation arrives, the asymmetry is gone. Institutions don't wait for clarity, they front-run it. Retail waits for price and pays for it. So if you're staring at XRP today wondering why it hasn't done anything yet, you're asking the wrong question. The real question is whether you're positioned before liquidity returns, or whether you're planning to react once everyone agrees the narrative is real. Now let's talk about the piece that ties all of this together, so market structure and capital access, because this is where most XRP narratives completely fall apart. People keep arguing price, charts, and timelines while ignoring the pipes that money actually flows through. Price is a result. Structure comes first. For years, crypto operated in a regulatory gray zone that didn't stop adoption, but it capped participation. Big money doesn't move without rules, not because it's scared, but because it's accountable. Pension funds, asset managers, banks, they don't get to YOLO. They need compliance frameworks, custody clarity, reporting standards, and legal cover. That's what market structure legislation is really about. What's different now, and this is critical, is that the delay is no longer existential. A year ago, the question was, will the US ever allow this? Today, the question is, which version passes and how fast? That's a massive shift. You've got pro-crypto leadership at the SEC, OCC, and CFTC. You've got ETFs approved and accelerating. You've got banks openly offering crypto-linked products. That doesn't happen in a hostile environment. And here's the uncomfortable truth. It doesn't actually matter whether market structure lands in 2 months or 8. The direction is locked. Once institutions believe the rules are inevitable, they start positioning early. That's exactly why ETFs exploded even before full clarity. Capital doesn't wait for perfection, it waits for probability. This is where XRP becomes interesting again, not because of hype, but because of where it sits in the stack. XRP isn't trying to be a meme, a culture coin, or a governance experiment. It's positioned around payments, settlement, liquidity, and interoperability, the boring stuff that actually moves money. That makes it ETF-friendly, custody-friendly, and compliance-friendly. When you see headlines like Bank of America offering Bitcoin-backed credit products, that's not isolated. That's a domino. Banks don't build one crypto product, they build frameworks. Once the plumbing exists, Adding XRP, enthusiast, or other large cap assets is incremental, not revolutionary. And once retirement accounts, advisors, and wealth platforms get access, you unlock a completely different class of demand. Think about this carefully. Retirement money doesn't chase pumps. It allocates slowly, consistently, and at scale. Even small allocation percentages matter when the base is measured in trillions. This is why the conversation around 401ks, IRAs, and ETFs is far more important than daily price candles. Now zoom out even further. The old 4-year cycle narrative is breaking, not disappearing overnight, bonus, but fracturing. In the past, everything moved together. Today, capital is differentiating. XRP, Bitcoin, and a handful of other assets are being treated fundamentally differently than speculative altcoins. That's why XRP can outperform quietly while most of the market chops sideways. This is also why corrections don't automatically mean bear market anymore. What we're seeing looks less like boom bust and more like repricing in stages. Infrastructure builds, capital pauses, liquidity returns, price expands, rinse, repeat. That's how mature markets behave, and this is where a lot of retail gets trapped. They expect fireworks immediately after good news. When it doesn't happen, they assume the thesis is broken. Institutions expect delay. They plan around it. They accumulate during boredom, not excitement. So if you're waiting for XRP to prove itself before positioning, understand what that actually means. Proof comes when the market has already repriced. By the time everyone agrees XRP is essential infrastructure, the asymmetric opportunity is gone. Now let's narrow the lens directly onto XRP itself, because this is where most people either overhype it or completely misunderstand it, sometimes both at the same time. First, forget the idea that XRP needs retail excitement to move. That's a leftover mindset from meme coins and early cycle altcoins. XRP doesn't live or die by vibes. It moves when liquidity routes change, full stop. The XRP ledger upgrades you mentioned, AMM improvements, escrow fixes, and version upgrades are not flashy. They're not supposed to be. These are the kinds of changes institutions actually care about. Predictable behavior, clean accounting, fewer edge case failures. No bank is routing serious volume through infrastructure that behaves inconsistently under stress. These fixes are boring on purpose, and that's a good thing. Now layer ETFs on top of that. ETFs are not just number go up tools. They are distribution mechanisms. They allow exposure without custody headaches, without wallet management, without regulatory friction. That alone expands the addressable market massively. And here's the part most people miss. ETFs don't need retail hype to grow. They grow through advisors, asset allocators, model portfolios, and retirement flows. If XRP ETFs continue at anything close to the current pace, you're not talking about speculative demand, you're talking about structural demand. That kind of demand doesn't panic sell on red days. It rebalances quarterly. Then there's liquidity. XRP has always been criticized for price suppression, but the reality is more nuanced. A lot of XRP liquidity is handled off-exchange, OTC desks, internal bank rails, and structured products. That means large volumes can move without immediately reflecting in spot price. Retail sees nothing happening while supply is quietly being absorbed elsewhere. That's not manipulation, that's market structure. When that structure shifts, when ETFs, custody platforms, and regulated on-ramps start competing for the same available float, that's when price discovery actually matters, not before. Now let's address the elephant in the room, cycles. XRP is no longer trading like a pure crypto-native asset. It's increasingly trading like a hybrid financial instrument, part digital asset, part liquidity infrastructure. That's why comparing it to 2017 or even 2021 is lazy analysis. The participants are different. The incentives are different. The time horizons are different. And this is also why the 4-year cycle obsession is fading. Institutions don't care about having narratives or Reddit sentiment. They care about regulatory windows, balance sheet efficiency, and settlement costs. If XRP saves money, reduces friction, and fits within compliance frameworks, it gets used, regardless of where we are in a cycle. And here's where I'm going to be blunt. If your entire XRP strategy is wait for the next big candle and then decide, you're already late by definition. That's reactive thinking. The real opportunity is positioning before the consensus shifts, not after CNBC starts explaining why XRP makes sense. But, and this matters, this does not mean blind conviction. XRP is not guaranteed to dominate everything. It doesn't need to. Even partial adoption across payments, tokenization rails, and settlement layers is enough to justify materially higher valuations over time. Anyone pitching XRP will do 100% of everything is selling fantasy, not analysis. The real asymmetric bet is this: XRP doesn't need to win everything. It just needs to remain relevant at scale. So far, it has. Now let's land this properly, because this is where most people either lock in a real edge or completely sabotage themselves. Here's the uncomfortable truth. Most XRP holders aren't underallocated, they're underprepared. They obsess over price targets but have no framework for time, volatility, or execution. That's backwards. If you believe XRP is evolving into infrastructure, not a hype token, then your expectations have to change. Infrastructure doesn't move in straight lines. It builds quietly, integrates slowly, and then reprices violently when the market finally notices it can't ignore it anymore. That's why patience isn't a motivational slogan here, it's a requirement. Let's talk positioning, not predictions. The biggest mistake retail makes is tying conviction to a date. By end of year, by next cycle, by 2026. Institutions don't think like that. They think in windows, not deadlines. Regulatory clarity opens a window, ETFs open a window. Liquidity easing opens a window. You position before the window becomes obvious. And you manage risk while you wait. That means two things most people don't want to hear. XRP can go nowhere for longer than you expect. When it moves, it won't give you time to think. Both can be true at the same time. This is also why all-in, all-out thinking is dangerous. If your plan is sell everything at $5 or sell everything at $10, you're not investing. You're guessing. Markets punish certainty. They reward adaptability. A smarter approach is layered thinking. Core position you don't touch. Tactical position you trim into strength. Cash reserves so you're never forced to sell. That's how you stay solvent long enough to benefit from the thesis actually playing out. And yes, custody matters more than almost anything else. Every cycle has proven this, and every cycle people still ignore it. Being early doesn't protect you if you don't control your assets. Exchanges fail, platforms freeze, rules change overnight. Self-custody isn't paranoia, it's basic operational hygiene. Now zoom out one last time. XRP doesn't need retail to believe harder. It needs institutions to continue doing what they're already doing, experimenting, integrating, and scaling quietly. The headlines will come later. They always do. If you're waiting for universal agreement before feeling confident, you'll only ever buy consensus, and consensus is expensive. So ask yourself the only question that actually matters. If XRP never becomes a meme, never trends on TikTok, never gets fun, but does become useful, compliant, and embedded, am I positioned for that outcome? If the answer is yes, then price noise doesn't control you. If the answer is no, then no prediction will save you. And for clarity, none of this is financial advice. Do your own research. Manage your own risk. This market doesn't owe anyone profits, and conviction without discipline is just another way to lose money. Stay rational, stay patient, and don't confuse noise with signal.